present. Take a look at Chapter 9, accounting for current liabilities. So this is picking up where we left off last week, where last week we talked about cash. We talked about accounts receivables. And now we're going to transition and start to talk about current liabilities. Let's first define liabilities. Somebody describe what you're seeing right now.
Probable future of assets or services that a company is presently obligated to make as a result of past transactions or events, such as a past transaction or event, a present obligation, or a future payment of assets or services.
You know I'm going to ask you to speak a little louder.
I know, I can. How is it? So you just want to know what that is?
Yeah, what are we defining here?
You're defining the characteristics of a liability.
Okay, now minimize that screen. No, look at that. Go up there and hit that little 4. Hit it one more time. Come to the dots. All right, back to defining liabilities. Who can define a liability?
A liability is the probable future payment of assets or services that we are presently obligated to make as a result of past transactions or events.
So let's focus on the past, present, and future. Past, this is due, it's a liability, it's an obligation that we presently have due to some past event. It's going to involve future sacrifices. How could you define it involving future sacrifices?
Paying on that liability?
Excuse me?
So we would like paying on the liability?
It would involve a payment. So it would involve taking cash, which is an asset, and we're going to utilize that cash toward the payment of that liability, which means we can't use it for some other use, even though that other use might be more beneficial to us. All right, so remember the present, past, and future components there. All right, let's classify liabilities. Current liabilities, expected to be paid within 1 year of the company's operating cycle. If you recall, when we defined a current asset, we said it was, the current asset was also, we looked at that 1 year period, and we said that if we were expected to use that asset within 1 year, we labeled it a current asset. So for a current liability, if we expect to pay it or satisfy it, we would classify it as a current. If we can defer payment or meeting the obligation longer than 1 year, we would include that as a long-term liability. When you see the term 1 year or the company's operating cycle, be aware that some entities may use an operating cycle shorter than 1 year. Just remember, 1 year is the maximum amount that we can go. All right, let's look at an example of Domino's Pizza. Well, in my example, let's look at Six Flags. All right, old note show Domino's Pizza. All right, so let's look Six Flags, 222 million. What we're comparing here is current liabilities as a percent of total liabilities. So 12% of Six Flags due within 1 year. Bowl America, Apple, and Columbia Sportswear. Okay, if you were an analyst assigned to these companies, what's something that might concern you right now? Or if you looked at this statistic, I mean, what might you want to see on the balance sheet?
I want to see less liabilities.
You'd want to see less liabilities, but remember those liabilities were there due to a past event. So they're already there on the balance sheet.
Give me a hint.
What could we use to satisfy a liability?
Cash.
Assets, preferably liquid assets. Or assets that we could, let's say liquid, assets that we can quickly convert to cash. We know that 87% of $260 million are going to be due in 1 year or less. So you would want to ensure that someone had Columbia Sportswear has sufficient cash or sufficient short-term assets that they could use in order to satisfy those obligations.
So what could be, like with Columbia Sportswear, what could be a short-term asset that they have that they could use towards that?
Okay, cash comes to mind first.
Okay.
What else is a current asset? Think of your balance sheet. What did we talk about last week?
Accounts receivable.
Accounts receivable.
I always think that is cash. I don't know why. I always think that falls.
Cash, what you have on hand. Accounts receivable, you're expecting it.
I know, but it just always comes to mind when I think of accounts receivable, means you're getting cash from something.
At some point, while you're in that expecting stage, you're in accounts receivable. Once you realize that transaction and receive that cash, then we record it as cash. Okay, it could be that you were expecting to liquidate some other asset within 1 year. All right.
Like equipment?
Well, I'd be careful with equipment. Usually equipment we use up, we depreciate it out.
Merchandise?
We put it out in a surplus. Merchandise, maybe if you were liquidating a piece of real estate, or even though that would be a long term, but you would expect that deal to close, you would want to make sure there was going to be a transaction that would involve cash arriving on the balance sheet before the next one was reported, hopefully, if you're reporting on an annual.
Jolie said outlet mall, so could that be a way that they like try to make more money off the like merchandise that's not being sold, I guess? Is that a way to like liquidate them?
Because you know how like a lot of stores like Kate Spade, Gucci, Saks, Columbia.
Yeah, stuff that doesn't sell, they go to the outlet and then they sell it for like a cheap price.
And they usually
Make a
always
profit.
have big sales to move it.
If they were trying to liquidate that inventory, would be an asset. So again, that would be an example. Yes, I can see. I don't know that I would probably want something if I was the banker that was going to loan Columbia money, I would probably want to make certain that I saw a more guaranteed source of payment or asset coming down. All right, what's next? That brings us into the uncertainty of liabilities. Now, a lot of you pay attention here because this is a part of what you could even transition. When I talk about personal experiences, this is something to listen up and apply to your personal experience as well. Whom to pay, when to pay, and how much to pay. 3 important questions. How are we going to decide?
Who's due first?
Who's due first? What else?
And then when are we gonna pay it? How much is due?
How much is due? The obvious answer is we pay them in order that they come due. You pay the first one. If you had one due, today's April 24th. So if you have a payment due on April 30th and another one due June 30th, we're going to go ahead and make the April payment first. I think someone said interest rates. Those questions can come up. You know, usually I always remind myself, what's our chief goal? Here's the principle that comes to mind. What's our chief goal? To maximize profit. Okay, so in order to maximize profit, we're going to need to utilize our assets in the most efficient way that we are able to. We're going to take the assets to satisfy these liabilities. So I want to try to be very efficient and satisfying. Now, the economists would argue, always trade it off as an opportunity cost. You know, obviously pay the obligation when it's due. How much to pay? Questions arise sometimes, do I pay the minimum payment or would I pay something down more? Now, I would say if I put my economic hat on, I always look at everything as a trade-off, and I take a look at what's the opportunity cost. If I take that asset, keep that in mind. If I keep that asset and I use it to pay a liability, that asset, that particular asset is gone. It's spent. Therefore, I have no other option for that asset. I'm only going to have use to that asset again if I go back and replenish it. Replenishing it meaning I sell something, I sell it through my operations of business, or I provide a service or a merchandising company. Here we get into if I were selling my inventory, but I have to do whatever it is that I do in order to replenish that asset. Known liabilities. Let's take a look at some specific ones. Okay, accounts payable, sales tax payable, short-term notes payable. What do you notice in those 3 descriptions?
Payable and liability
Payable.
are used a lot.
All right, so when you see the word payable, let that trigger the first notion that you are dealing with a liability. What's the triggering word for an asset? Receivable. All right. Unearned revenues. What's an unearned revenue?
Amounts received in advance from customers for future products or services.
So we've already received. We've already received cash, but we have an obligation to perform whatever it was that we were paid for. We have the liability of still performing that task.
So could paying extra on a loan be an example of like an unearned revenue?
Paying extra on a loan.
Yeah, like.
When you think of payment on unearned revenue, think of your automobile insurance. Well, let's say that because I'll look at it from the insurance company's perspective. Okay, if your auto insurance is due on June 1, so the period from June 1 to December, into December, and you pay it in advance. So you just prepaid 6 months in advance to the insurance company. The insurance company receives your cash, but have they earned it? No, because they still have to provide you with insurance coverage for those 6 months.
Like that example. That was very good.
All right, multi-period known liabilities. These would just be ones that would extend for multiple operating cycles or multiple years. Okay, so we're looking for the word payable, unearned. Obviously, if it has a liability in the description, we think of it as a liability, but we'll look more on payroll liabilities. Why is it important that we assign the correct category or the correct account under our transactions? Why is it really important that I call something an accounts payable versus unearned revenues?
I would say for record keeping and tracking purposes.
Absolutely, for tracking, for record keeping, any of the ratios that we've looked at. You know, remember, to calculate these ratios where you're actually going to, that's where we start telling the story. We're going to pull data from these accounts. And if we have incorrectly assigned something to the wrong account, it's going to cause errors and skew any of our final calculations. All right, good job. All right, sales tax payable. Home Depot sells materials for $6,000, subject to a 5% sales tax. For us in Indiana, what's our sales tax? 7%. Bless you. Wisconsin, what's your sales tax?
$6,300 is actually.
I can't hear you.
Oh, 6,300.
I said, what's your state sales tax?
Oh, I have no idea.
Oh my.
I just give them all my money.
I encourage you to find that answer. Kentucky, what's your sales tax?
6%.
6%. All right, so August 31st, Home Depot sells materials for $6,000 that are subject to a 5% sales tax. How are they going to account? All right, over on the left, we have the date. Now, how much money did they receive? They received $6,300. But they are going to assign, they're going to debit $6,300 in cash. We are going to credit those sales $6,000, and we're going to track that sales tax payable with the $300.
I found it. It's 5%.
5%.
You.
Now that would be important. Think of it as the Home Depot now. You're tracking what's in that sales tax payable, because at the end of every, I don't know how often they send it, but let's just say every month, what must they do with that sales tax payable? Pay it to who?
To the state.
To the state. Okay, so Home Depot has to track, remember, that's a liability. At come the end of the month, assuming they're on a monthly cycle, at the end of the month, they are going to have to send all of the sales tax payable that they have collected from the past. They're going to have to send that payment there. So they would want to be sure that they had sufficient assets to where they could write the check when the obligation was due.
Kind of like your assessment that's done every year. When they come around and redo the assessment on your property and your house, they're
Did you just
taxing
receive yours?
Yeah, I got mine the other day.
I did too.
Luckily, mine's Harrison and not Clark.
Well, I was going to say, I looked at mine and I was reviewing it with my wife and I said, hey, can you believe our property value? It shot up. I'm in an area where it's growing and I mean, it shot up. And she said, wow, that's great, isn't it?
No.
And I said, well, honey, if you were selling the house, yes, but experience has taught me that there is one time you do not want to brag.
Next time.
Tax time.
You got it.
Keep it shut.
Well, it didn't Indiana start that new thing where it took like the whole like state, it looked at the whole state, like everybody's property taxes and then made it like an average. And so you have to pay on, like my friend, she lives in New Albany and she said that her taxes went up like 302% because of this new law that they did for like taxing people's houses or property taxes.
Indiana put a maximum, they put a cap on the amount of taxes they can charge, and for
Yeah, she's
residential,
gotta do that 1%.
it's 1% for residential homes. And I'm gonna say most folks are usually pegged right around 1%.
She said that it still made her property taxes go up like $1,200.
She can ask for a reassessment.
She said it was ridiculous. She was mad. She was bit fire about
Talk to her county assessor.
You'll.
All right, unearned revenue.
Rihanna.
On June 30th, Rihanna sells $5 million in tickets for 8 concerts. So on June 30th, she collects $5 million. So we debit cash for $5 million. What are we crediting?
On June 30th.
On June 30th.
unearned ticket
Right.
revenue.
Who said receive? I receive.
Why?
Well, it's due.
Do us. Oh, we have to pay.
You've already received the
sorry.
$5 million.
Yeah,
So
it's
we're not gonna have a receivable here because we've already received $5 million in cash.
But we have performed the
But we have not
concert yet.
performed the
Right,
concerts
so-
to earn for it. So we are gonna credit an account called unearned ticket revenue. Now, again, let's look at a band, let's look at Rihanna. Okay, notice we take unearned revenue, now we're adding the title ticket in there. Because there could be other types of unearned revenue that her band might be obligated to. So again, by creating a separate account called unearned ticket revenue, it's going to distinguish that from other types. And remember, there is no limit to the number of accounts that a firm will have. You want to make sure that it's appropriate to your accounting operations, or you want to make sure that it is as specific to.
Yeah, because you have to make adjustments to this as well, if for some reason she got sick and couldn't make the concert. Then you have to create another one for refunds or whatever.
So on October 31st, she's going to perform the first concert. So it looks like taking $5 million divided by 8, she's going to be paid $625,000 for each concert. So from June 30th, we credited $5 million. Now look, we are going to debit $625,000 unearned ticket revenue. So we're going to remove it from that obligation. And we will credit ticket revenue. We have now earned that $625,000 portion. All right, multi-period liabilities. It includes unearned revenues and notes payable. So let's look at an example. Unearned revenues for magazine subscriptions often cover more than one accounting period. So again, a portion of that revenue is recognized each period, and the unearned revenue account is reduced. That's exactly what we just looked at with the Rihanna concert. Remember, when we realized that first concert day, $625,000, we reduced the amount of unearned revenue by that amount. If those concert dates spanned more than one accounting period, this is what we're talking about, multi-period liabilities. Now, when you see the term notes payable, most often these are going to extend longer than one accounting period. So if we had a 3-year notes payable, you're going to assign 1 year as the current, 2 years as long-term. Now, notes payable. Give me an example. Car payment.
Wouldn't like, well, I mean, basically, it's kind of like an IOU and you're paying on the IOU, right?
An IOU. I'm a company and I was going through some type of,
Hardship or something.
well, let's just say I was going through equity financing. I'm trying to raise equity for, I'm gonna buy my competitors. Okay, I may go to the bank and ask for a loan. I may enter into the bond market to where I would sell bonds in order to raise capital. And those bonds would be individual investors. If I'm entering the public market, individual investors loan me money. I'm going to have a stated interest rate on that, and I would pay you. It would have a stated interest rate and a stated term, and I would pay you. So you give me $1,000, and it's a 5% bond for 10 years. I pay you 5% for 10 years, and then at 10 years, I've got to give you your principal back. All right, some known liabilities that we will rarely ever see on a long-term or multi-period liability. You will rarely ever see accounts payable. You'll rarely see wages payable. And sales tax payable, you will not see. So think of taxes, wages, and accounts payable. You're not going to find them up here on the long-term side. Short-term. All right, a written short-term notes payable, a written promise to pay a specified amount on a definite future date. Okay, this is just what I described, so let's advance. All right, on August 23rd, Brady asked McGraw to accept $100 cash and a 60-day 12% $500 note to replace its existing $600 account payable. Looks like Brady doesn't have $600 or has found better use of that $600 on his balance sheet. So he comes to McGraw and asks him to accept $100 cash, and then he's wanting to finance the remainder over 60 days at 12% interest. So right now, McGraw is carrying an accounts payable of $600. They are going to debit the accounts payable, and now crediting cash $100, that's the amount they just received, and then $500 matching the amount of the note. Remember, first payment, we've just received $100, so we've not started to receive any payment off of the finance portion. Okay. Now, on October 22nd, Brady's going to pay the note plus interest. So now we're carrying a notes payable for $500. But how much cash we received? $510, which is going to reflect the $500 plus $10 in interest. Everyone see how they calculated the interest? All right, again, they used that banker's rule. Remember, dividing by 360. So $10 in interest. Now, of the $510 in cash, we can say that it is represented by $500 in notes payable. And again, we're tracking interest expense of $10. Now we're going to the bank and we're signing a promissory note. Remember, promissory note's gonna look very similar to the check. Upper left corner, the face value of the note, upper right corner, the date. Terms are written out, there in the middle, 60 days. After date, and the borrower's name is gonna be right there under I, promise to pay in order of, the recipient is gonna be listed next, and then we're gonna write out the amount, $2,000 is written out to match, like what's up in the upper left corner. Okay. Let's look at how we would account for this. So on September 30th, we borrowed $2,000 from the bank at 12% interest for 60 days. So on September 30th, we're going to debit cash for $2,000. But now we owe that $2,000. So notes payable, $2,000. Assets are going to equal liabilities. Now, November 29th, we repay the principal plus interest. So again, our accounting would be debiting notes payable. So we're removing it at that point. Just compare that transaction to the one on September 30th. We're satisfying that liability, but we also paid $40 in interest. Total cash outlay, $2,040. So we credit cash the amount of principal and interest, or the actual amount that we paid. So we just reduced our cash by $2,040. Now, let's look at some adjusting entries. Whenever we find that the liability is due at the end of an accounting period, it's going to require us to record accrued interest as of that date. All right, so let's look at an example. So here's one of our adjusting entries, so pay attention. On December 16th, almost my birthday, a company borrows $2,000 from a bank. Again, 12% interest for 60 days. We need to make an adjusting entry as of December 31st. All right, how much interest did we incur during that month? $10. So on December 31st, we want to record the amount of interest that we actually accrued. So that expense, and the reason, why would we make this adjusting entry?
And this one is to record accrued interest for 15 days.
Because you don't get like the full amount of like a month long interest. So I don't know how to word it right, but you're paying like not as much interest as you would if it would have ended at the end of the month, right?
Well,
So like
I'm
instead of
looking at, why am I
$40
making this adjusting entry? So I borrowed it for 60 days. I'm mid-December. There's only 15 days remaining in the month or in the year. And now I'm going ahead and making this adjusting entry as of December 31st.
Because I was able to receive, so it's like an accounts receivable, even though it's a small portion, so you need to record it because it was coming in as a payment.
because the fiscal year ended. Right.
Rather than, both of you are correct, rather than say physical, you just say because the accounting year ended. Fiscal usually implies something other than calendar year. Okay, so the calendar year ended. And the reason I say fiscal year, they'll think usually like higher learning, like schools. It's not uncommon that a school will end their accounting year at the end of the summer terms. Thinking of the fall semester as being the new and first term of the new academic year. But you would want to, if I'm recording this expense, Where are my expenses going to go on December 31st? What statement am I going to prepare that's going to involve that expense? The income statement. Okay, the income statement, I'm going to show revenues and expenses. I've got to record the amount of expenses that I incurred in that year. So if I were to record, if I did not do this, and I failed to do this, and I went ahead and prepared my income statement for the year end 2015, it would not accurately pick up the amount of interest that I accrued. Now, on February 14th, we repay P&I on the note. This is going to look very similar to what we just said. Here, we're going to record the accruing of $30 in interest. In order to look at the full amount, though, we've got to pick up that $10 of accounts payable. So that's going to show the amount on the note, and then we see the payment of the full $2,000 in principal. Total cash outlay on February 14th was $2,040. All right, keep advancing this. And let's pause right there. Take a break, come back, and talk about. Okay, let's pick back up with payroll. Payroll liabilities. Would you like to get paid? Pay attention. All right. Employers incur expenses and liabilities from having employees. Does anyone work for free?
No.
And I would ask, do any of your employers provide you with, just out of curiosity, file with you what's called like a total compensation statement? If not, try to calculate that for yourself, because when you look at your payroll and you add any of these other items, any perks, any employee benefits, that total comp statement can add up really quickly. And your net or your paid negotiated pay scale would not even be reflective of your total comp. And when I say total comp, I'm talking about total expense to your employer. All right, so right now let's just focus on gross pay. But everyone probably knows what their gross pay, but what must come out of that before we get to cash that check and have spending? We're going to pay federal income taxes. We're going to pay state and local taxes. And that becomes the net pay. Now, out of that net pay, what else?
Health and benefits.
Your health and benefits, any voluntary deductions that you've signed up for.
But isn't it not considered voluntary for healthcare anymore?
Is it not considered voluntary?
Yeah, because you have to have health insurance.
Well, if there are options for you to choose from, you are volunteering to pay for that particular plan.
But I said that.
Technically, it's voluntarily with your employer. Just because you have to have insurance doesn't mean that you have to have it with them.
Well, some of them won't let you opt out unless you have another insurance plan.
Now on Texas.
Okay, now, FICA taxes. When I say FICA, I'm referring to Federal Insurance Contributions Act, FICA. So Social Security. Someone real quick, open that Google browser and hit 2017 FICA tax rate. Tell me what it is.
Wait a minute, Social Security tax, Medicare tax,
Social Security. Social Security tax.
it's 1.45?
No,
No,
it's Medicare.
6.14.
All right, 2017, we see it's 6.2%. So it's not been changed since 2014. So 2014 and 2017, 6.2% on the first 117,000 earned. Now what will change, back to the calculation, what's that 6.2% on the first, and give me a dollar amount?
127.2.
127,200. So the stated interest rate remains unchanged. However, the income limit increases and is pegged toward inflation. So we're going to look at 2014. I just wanted to make a distinction of how these numbers change with time. So in 2014, 6.2% on the first 117,000 earned. And on Medicare, 1.45% on all wages. There is no income limit. Now, what's that mean? What if you earn $200,000?
You get taxed on $200,000 for medical.
For Medicare. But on FICA, you would only pay on the first 117.
Correct.
And employers must pay withheld taxes to the IRS. So on some schedule with the IRS, your employer, weekly or monthly, your employer is taking those taxes that they withheld of your money, and they're forwarding those, making those payments on your behalf to the IRS.
Unless you file exempt.
All right, now, employee income tax. Amounts withheld depend on the employee's earnings, tax rate, and number of withholding allowances. All right, employers must pay the taxes withheld from the employee's gross pay to the appropriate government agency. So again, you're going to send those federal income tax dollars to the federal government, and any state taxes to state government, and any local taxes, you will send those to the local taxing jurisdiction. Now, amounts withheld depend on the employee's request. And the examples include union dues, savings accounts, pension contributions, insurance premiums, and charities. All of these might be options to you that you can have withheld. Employers owe voluntary amounts withheld to the designated agency. So I know here locally, sometimes you'll see United Way listed as a recipient or one of these charitable organizations. If your employer, if you designate and request that your employer withhold money for United Way, your employer is responsible for forwarding that withheld contribution to United Way. Now, let's look at what a payroll item would look like. So for someone who receives a $2,000 salary,
It's monthly or by year?
Per month.
Referring to here.
excuse me,
This weekly, monthly, or year?
well, that's as of January 31st.
It's monthly.
Ouch.
Now, $2,000 is your salary. Now, of that $2,000, you see how it's broken down. FICA, Medicare, income tax, medical insurance, union dues. Okay, so that's the amount of required and voluntary deductions. So the net salary, $1,524, that's the amount that your paycheck is going to be made payable for. And then your employer, of course, is responsible for forwarding those other amounts to the corresponding agency. Payroll expenses. Here we go again. Now listen, FICA and Medicare, you paid 6.2% on FICA, and you pay 1.45% to Medicare. Guess who else pays that for you? Your employer is required to match that amount. So now we're looking at the expense from the employer side. So whatever your 6.2%, your employer kicks in 6.2% of their money and matches your contribution. And the same thing for Medicare. You pay 1.45, they pay 1.45. Now we have what's called FUTA and SUTA, unemployment taxes. 6% of the first 7,000 wages. And you will receive a credit for state unemployment taxes paid. Your state unemployment tax, 5.4% on the first 7,000. Merit ratings may lower SUTA rates. Okay, your state government, the unemployment agency, each year is going to send you a merit rating. And this merit rating is going to be based off of factors such as how long you've been in business, the amount of your payroll. Most importantly, what are the claims against that payroll? If you've ever heard of stories of where employers have disagreed with employees over entitlements to unemployment insurance, this could be why. If there are a lot of claims against their unemployment account, so they're paying in these taxes, and if there are a lot of claims against that, guess what happens to their merit rating? Your rating would either stay unchanged, or it could, if you had it lowered in years past, it could be raised back up. So that's why we have merit ratings. So now what we're going to do, recording your payroll taxes. Now we're the employer. So January 31st, payroll tax expense. Total expense was $273. But we have to account and break that down to FICA, Medicare, SUTA, and what I'm calling SUTA and FUTA. So the SUTA tax, it looks like we're applying the full 5.4% and then we're getting the credit down on FUTA, so we're just taxed at 0.6. All right, keep advancing through the need to know. Estimated liabilities. All right, what's an estimated liability?
Obligation of an uncertain amount that can be reasonably estimated.
Okay, key words here. Known obligation. We know we owe. Uncertain exactly the amount we owe, but we can make a reasonable estimate. Give an example, health and pension benefits. Now, here's an example of your employer agreeing to pay an amount for medical insurance equal to $8,000 and contribute an additional 10% of your gross salary into a retirement program. Total benefits expense is $20,000. And of that $20,000, we credit medical insurance payable $8,000 and retirement plan payable $8,000, or excuse me, $12,000. Vacation benefits. Soon you earn $20,800 per year, and you get 2 weeks of paid vacation per year. What's the amount of your weekly vacation benefit? $16. So again, total expense debited $16. We know we are going to owe this obligation, so we credit vacation benefits payable. Was there a question about that?
No.
It is for me. You saying, from here, are you saying that we pay that?
No.
Oh, I was
We
gonna say, 'cause I'm
transitioned
like,
down, we're on the employer side.
okay. I was gonna
I
say,
think
wait,
that's what I
wait.
We've been with the employer for about the last,
That's what I was.
No, but I got confused and I started thinking like, wait, we pay for our own vacation time? Okay, I got it now. I got it.
Now, I have a question.
go ahead.
What about somebody like me? I'm a night shift worker. When I go on vacation, I lose my shift dip. What does that do?
When you go on vacation, you do not receive a paid vacation?
I do receive a paid vacation, but I don't receive my shift differential. So I have my base salary, and then since I work night shift, I get extra for being night shift.
Your
But when I go on
vacation is paid
vacation-
off of a normal,
Yes.
okay, so they would estimate, again, what's the difference? Go back to the previous slide, please. They would look at what is your normal. They might even include an additional item there because your weekly salary is going to be based off of base salary plus night shift differential.
Okay.
They know they're going to pay you. If you did not take that vacation, they'd still pay you 52 weeks for that time.
Okay.
But if there's a greater benefit to them down there, you know, and they might have another item, vacation benefits still the same, vacation payable, and then there might be an item down there that says shift differential. But you would be sure you wanted to capture that knowledge. You'd want that data, you would want to know that data.
I don't remember how it worked. Now I do. Look at that.
Bonus plans. Okay, now assume that the employer is going to pay employees a bonus equal to 5% of annual net income. All right, so the bonus plan, we're going to take 5% multiplied by 210,000. We're calculating the benefit. We see that our benefit is equal to $10,000. So we're estimating here, remember, we're using estimated liabilities. We're not going to know right now, here's a good example, we are not going to know at the beginning of the year where net income is going to be. So if we were planning that liability for year end, we would have to have a reasonable basis from where we thought net income might be. And again, making sure that we had sufficient assets available to pay this bonus. Warranty liabilities. All right, seller's obligation to replace or correct a product that fails to perform as expected during a specific period. To comply with the full disclosure and matching principles. Full disclosure and matching principles, the seller reports expected warranty expense in the period when revenue from that sale is reported. Again, you're going to have to make an estimate of the amount of warranty liability you're going to incur. So on December 1st, we sell a car for $16,000 with a maximum 1 year or 12,000 mile warranty covering parts. Now, how are we going to make this basis? The first place that employers look are past experiences. So past experience is going to indicate warranty expenses average 4% of the selling price. So again, on December 1st, our warranty expense, we're expecting $640. Now on January 9th, 2016, we're still within that warranty period. customer returns the car for repairs, and the dealer replaces parts costing $200. So here we're going to debit estimated warranty liability by the amount paid, $200, crediting auto parts inventory. We're reducing the inventory. Any questions? Contingent liabilities. All right. What's a contingent liability?
A potential obligation that depends on a future event arising from a past transaction or event.
All right, a potential obligation that depends on a future event arising from some past event. So in order for something to incur, it's contingent upon something from the past. So something has to happen before this next event is triggered. Okay, so the future event, before we call it a contingent liability, we have to say that, is it probable, possible, or remote? What do we do?
By
Go ahead.
that you mean, is it probable, possible, or remote that we are gonna have to pay on this
Correct.
liability? Okay.
If it is probable, what are we doing?
Estimating or not estimating?
All right, if it is probable and we can easily or accurately estimate the amount, we're going to record the liability. If it's probable and we cannot accurately estimate, we're going to disclose it in the notes. Now, if the contingent liability is only possible, we're just going to disclose it in the notes. And finally, if it is remote, meaning here that the future event is very, very, very unlikely, we do not record or we do not disclose in our notes. All right, let's look at some reasonably contingent liabilities. Potential legal claims. All right, potential legal claims are recorded if the amount can be reasonably estimated and payments for the damages are probable. So if you go back to the prior slide, that's going to meet that chart. Debt guarantees. We're usually going to disclose the guarantee if it is probable that the debtor will default. Okay, if it's probable that the debtor will default, we're going to record and report it as a liability. So we're guaranteeing someone's debt. Again, if it's probable, well, we'll say this, if it's expected and can reasonably be estimated, we're going to record it. If it's probable and we can estimate it, we're going to record it. So that's what, when we're looking at these two specifics from the prior slide, they're going to match that flow chart. How do we end in every class of what was the last two sections that we covered? We always took a look at the global view. And I couldn't get you out of here if I didn't show you a ratio. We've ended every class with the global view and a ratio. So go to the slide of the global view. All right. What do we see? All right, both GAAP and the international reporting standards are going to define current liabilities very similar. Sometimes international standards will use the word provision to refer to a liability. If the known determinable liabilities, both US and GAAP require companies to treat known liabilities in a similar manner. So again, both standards are going to be similar with accounts payable, unearned revenues, and payment liabilities, payroll liabilities. And again, both standards are going to require similar treatment with estimated liabilities. So if the obligation is known and can be reasonably estimated, remember, we're going to record it. Now finally, the ratio. Times interest earned. All right. What's the time interest earn ratio going to tell us?
Income before interest and income taxes divided by interest.
All right, if income before interest and taxes varies greatly from year to year, fixed interest charges can increase the risk that an owner will not earn a positive return and be able to pay interest charges. The time interest earned, income before interest and taxes, divided by the interest expense. How efficiently are we managing that debt? So remember, how efficiently are we managing that liability that's accruing our interest expense? Okay. Hit the escape button. Go over and hit stop share. All right, I'll maximize that screen. Go over there and click on the whiteboard, double click it. Over here. This box. Double click it. Go over and hit right here. Here. Spotlight video. All right, so you saw the term up there, income before interest. And I'll just leave you with one final acronym that has become a popular reporting measure that firms sometimes will post. I'm kind of from the old school and I want to see it. Income always post as true, well, truly what income is. But does anybody know what EBITDA?
Earnings before interest, taxes, and amortization.
Earnings before interest, taxes, and amortization. So that's going to become the amount of earnings that you have before you pay any interest on your debt, any taxes to that government entity, and any amortization charges. Sometimes referred to as top line revenue or top line earnings. So I shouldn't, let me reclaim that. Top line would be at the very top, your gross revenues. So we, at this point, we've met our expenses. So I guess we call it middle level revenue. So next time you see that, or if you do see that, you'll know what it means.
That's all of the chumps over here are little.
Hopefully.
You said
I
that.
just see that every day of my life.
You said that, and I
That's
was
what we
like,
focus on, yeah. All
right, any questions?
no, sir.
We good? All right. What do you have to do this week?
Study.
Study.
Homework.
Homework,
specifically,
discussion.
discussions,
Mhm.
Homework,
homework,
general ledger.
your
That's,
a little assignment, your 10-point assignment,
yeah, then final.
Yeah, I like how these 10-point assignment ends up being like 10
and
pages.
then the final
exam.
final
I'll do
exam.
my Saturday. and-
Remember the points that are still on the table. Remember our grade distribution. This is your final week. No, nothing else will be assigned to you. This is your final week to get everything turned in. That includes any assignments that you fail to complete throughout the term. Be sure you get everything submitted before when?
Saturday and midnight.
Saturday at midnight.
AKA 11 our time, correct? Or is
It's
it
our time.
It is our time?
It is our time. Let's
Oh.
be done on our time.
I've been trying to turn everything in for 11.